Seshadri, I must say your note at least seems to indicate you're quite optimistic, on the outcome of what's happening in West Asia. You're talking about peace trades. You're talking about oil at 80. Currently, Brent is hovering, above 100 for the last few sessions. How do you advise investors to position portfolios in this highly choppy market, up one day, down another day, in a day like today, up and down so many times?
Yeah, thanks for hosting me on your show. Yes, that remains a medium-term call. I think the logical outcome is that at some stage the Strait of Hormuz will reopen and oil will, in which case, go back to $80. And you're right, our model portfolio is positioned for that outcome. But that doesn't mean it's about to happen tomorrow. We think it will take a few weeks to happen. In the short term, however, there are multiple downside risks to the market at this point in time. As we see, as we've earlier said in our previous notes, that if we are wrong and oil does sustain at, say, 105 to 110 for a sustained period, then the macro implications for India are quite severe. The external account will come under severe pressure, and we're seeing some measures that the government is taking to alleviate that. We think that there could be more measures to alleviate the current account. It's one thing to say that the end of the war is around, but the policymakers have to deal with the immediate stresses that are around. So expect a few more measures. We can't at the moment. It's a little difficult to predict what will go, but there is a range of options that the RBI and the government has to take some pressure of the external account, and a lot of those will be negative for equities. So. Yes, in the medium term, we are optimistic that the straits will reopen, oil will revert, but there is some short-term pain ahead if oil remains at 105 to 110.
Yes, some short-term pain is ahead if oil remains where it is. But, the biggest overweight in your portfolio is consumer discretionary. You have a mix of internet, autos, retail. But, these measures that you're talking about, for instance, the gold duty hike that's already come in, that's going to impact consumption. There's obviously talks about a weaker monsoon. Inflation is inching up as well. Near term, do you see some downside pressure before perhaps a recovery, really kicks in?
Yes, there is some risk to that in the near term. And the big one that is obviously the most likely is a retail fuel price hike. We have written in the past that if oil does not fall and remains at these levels, then retail fuel price hike is very likely in the coming days and weeks, and likely to be in the region of about 10 rupees per litre for both petrol and diesel. That will have an immediate impact all around. It will push up inflation. It will eat into the consumers' spending basket, and therefore other discretionary consumption will take a hit. Autos, which is the largest part of the consumer basket, will see an immediate hike, increase in the cost of ownership, which will have a consequent impact on demand. So yes, in the short term, there are some pressures that could come through in terms of consumption. But once the war ends, which we think will happen at some stage, then we've had multiple consumption stimuluses over 2025, which should then start to kick in, and we're seeing already some of that in the current results. A lot of consumer companies have reported fairly strong numbers in terms of and are talking about strong underlying demand.
Seshadri, I was reading your changes to your model portfolio, and the three stocks that you have highlighted, all three of them belong to sectors that are currently in the line of fire. First one, of course, is fertilizers. The other one is real estate. The third one is IT. You mentioned Deepak Fertilizers, Lodha, and Hexaware. And I'd specifically point out real estate, Seshadri, your stance on the sector. Of course, if you are at a liberty to talk about that particular stock, very well. But on the sector as a whole, the concern here is that with all the headwinds that IT is facing, the second order impact might be felt on real estate, and there is also a fear that this upcycle that the sector has been in is possibly reaching a plateau and it may now start to taper down.
All of that are true, but you have to take valuations into account and the stock price corrections into account as well. We are expecting, most of the companies to show slightly slower growth in the next 2-3 years than they have in the last three years. But the stocks have viciously corrected, and many of them are now trading at NAV or below NAV. So it is a little moot as to whether they will sustain the growth in the past. The market will look ahead in the future. As far as the IT impact on the real estate demand, yes, there will be some impact in particular pockets like Bangalore. But I think it's a big leap, and also GCC hiring is fairly strong. So it's a big leap to say that just because of the IT pressures, the entire national real estate market will collapse. That's I think a bit of a leap. We still expect healthy growth. You also have to remember that mortgage rates have fallen 125 basis points from the peak, because that is one part of the lending universe which is almost immediate transmission. So that impact is yet to play out. And therefore, we certainly think that while, yes, some of the companies may show slower growth, there is still fairly healthy growth coming through, and valuations have corrected quite sharply. We introduced real estate in our model portfolio only recently after the recent correction.
Well, in that case, Seshadri, you have also highlighted some important overweights as well. The fact that you have an exposure to L&T, Tata Motors, commercial vehicles, delivery. Well, on L&T and the entire capital goods space in general, there has been this worry about the fact that L&T, of course, has the West Asia concern. ABB's numbers, the stock got smashed after its results, and the slew of downgrades that came in with regards to the valuation concerns and so on. But with the kind of headwinds / tailwinds, it's a bit of a conundrum for this entire capital goods space. Where does your preference lie? Of course, with L&T, yes, but other than that, in the transmission segment or in some other areas within the space.
Yeah, so one has to be, the capital goods space, and L&T is not your typical capital goods stock. So let's leave that. But the capital goods space, which you were asking about, the underlying fundamentals are fairly strong. I think that demand across power transmission, defense, even railways should be fairly strong over the next 2-3 years. Railways, maybe, one has to wait and watch a little bit as to how the government copes with the fiscal pressures of this current crisis. But power transmission and the entire power universe and defense should see fairly strong demand. But you also have to remember that many of the stocks in that universe are at very high valuations. And therefore, even a slight surprise, and thirdly, some of them will have to contend in the short term with raw material prices, which may take a little longer to pass on, to the end consumer. So if you combine all of that, the sector fundamentals look very strong, except for the margin caveat. But you have to keep in mind valuations and be selective in terms of pick stocks with reasonable valuations, and look at the next 6 months to 1 year momentum rather than take a top-down call. It's more a bottom-up stock picking industry than a long term. With regard to companies with exposure to the Middle East, they've been beaten down, obviously, for obvious reasons when this broke out. But again, that is part of our normalization trade. We think that when everything settles down in the Middle East, business will come back to normal, and in some cases they may need a reconstruction and increased demand. Therefore, that will be relatively small, but that also would come into play. So we are looking through this West Asia crisis and looking at stocks which can recover after that, because many of them have corrected quite viciously since from the early March, and looking at them as the recovery trades. As the note said, I think we have about 25% exposure to a post-war scenario.
Seshadri Sen, pleasure having you as always. Thank you so much for sparing time and joining us today with your views on the index and your top preferences in your model portfolio as well. The markets continue